expect more weakness in the days and weeks ahead. If you ask Joe Quinlan, he's the chief market strategist at U.S. Trust, Bank of America, Private Wealth Management. But he does have a more bullish outlook for the year, right, Joe? You think we could end here at 1425, so that's not a bad run if it comes out.
That's right, Matt. We still see more upside. We'll see some sogginess in May and June as we kind of get closer to this Q2 earnings, and we still got some problems to deal with the debts and the deficits here. But I still see good earnings, good global growth, and the weak dollar is really going to help in Q2 and Q3 when it comes to these big multinationals.
You know, Joe, Julie's been kind enough to just shoot me over some headlines from the Fed's Fisher. He's talking about how he would be among the first to support tightening. He says basically the Fed has done as much as it can to boost the economy. So with this debate over whether or not we get more quantitative easing, is he right? Do you think the Fed has done as much as it can and it's time for the economy to just kind of soar on its own, or hopefully soar on its own?
Soar would be good.
Yeah, I'm hoping here.
Yeah. We're not looking for QE3, and I think Dick Fisher's right in the sense that this economy is generating its own strength. You got good corporate earnings. This is going to be a corporate-led expansion. More hiring, more capital expenditures. If we do have to do QE3, there's something obviously more structurally wrong. But I think he's right. And I think what will bury QE3, and people will come to recognize that we're in the economic expansion. The recovery is only 2 years into the process. They typically last 5 years. So we got some upside here.
Joe, we had a cool chart that Doug Cliggett over at Credit Suisse brought in yesterday when he was on the show, and he showed the correlation between the Fed's balance sheet and the S&P 500, and it's a very strong correlation. So you're not worried even a tad? Just quickly.
No, not really, Carol, because I do think it's good earnings, good overseas money, still strong demand for U.S. Treasuries. We'll be okay.
One of the interesting things I thought in the Dick Fisher headlines that Julie just sent us, that we just got across from his speech in New Mexico, he says he's confident in the Fed's ability to contain inflation. Now, clearly, this is something that somebody who's running a central bank should be saying, or at least you hope they're confident about that. But do they really have a handle on it? We're seeing gas prices at $5 a gallon here in New York. Food prices are soaring. It's hurting people on Main Street. I mean, do you think they have a handle on inflation?
You know, Matt, I think they do, and I think what Dick Fisher is talking about, when you look at food and energy prices, is the overall CPI component for the U.S. It's very small. It's around 10%. So those prices mean less to Americans. They mean a lot more to the Indians and people in other parts of the world. And I think that's what he's talking about, number one. Number two, there's really no wage inflation coming here in the United States as well. So you can't get that wage push price spiral underway, and I think that's what the Fed's talking about.
I mean, the thing is, the food costs are becoming more and more of the average American's budget. I think we're at 12% now, which is fairly high. And, you know, if you look at wage inflation, if there's nothing going on there, housing inflation, which is a huge part of what the Fed looks at, nothing going on there. And then these components are where you do see the increases. That's got to be painful for the American consumer because he's not getting anything at work. He's not getting anything from his home. Only the things that he needs to buy to live are getting more expensive. I mean, maybe there's a problem with the Fed input as far as the data that they're looking at.
Well, yeah, I mean, these indices were constructed a long time ago, and you can always argue about that. And to your point, Matt, you're also seeing at the state and local level taxes rise. But that's one reason why we're focused more on the corporate side, more on the capital expenditures, and not the consumer. Because I do agree with you. The consumer is going to be continuing to be squeezed. Staples are more expensive. It's going to cut down on discretionary spending. So, and I think that's a story that's going to be with us for the next 2 or 3 quarters.
Hey, Joe, you definitely sound rather upbeat here. I want to bring in Credit Suisse chief economist Neil Sauce. He told Bloomberg this morning on Tom Keene's show that the U.S. economy has a problem, so listen up.
In some ways, we are now looking like an emerging market of the past, where the domestic economy is not doing terribly well, but the export sector, symptomized, if you will, by that ISM manufacturing versus services kind of disparity, is what's got to carry the economy forward.
Joe, what do you think? I mean, do you agree with what Neil Sauce says in terms of how he assesses the U.S. economy right now?
You know, I do, Carol, because I do think slowly but surely the composition of U.S. growth is shifting away from housing, away from consumption, and more towards capital exports in general, investment. Conversely, you're seeing more consumption coming out of the emerging markets, less exports. It's global rebalancing, and it happens at a glacial pace. That's frustrating, but nevertheless, it's happening. And long term, that's very healthy for the U.S. companies, for the global economy, and for U.S. investors in large cap stocks.
I want to bring in Adam here because, Adam, you have a curious take on wealth in the U.S. versus wealth in China while we're comparing different nations here.
Well, yeah, Joe, you're going to love this one. You're a pretty intellectual guy, Joe. So let me share with you a study that Deloitte just put out. And what they're doing is trying to quantify wealth in the U.S. versus wealth growth over the next 10 years in China. In the U.S., they say millionaires' wealth will, in aggregate, go from 39 trillion up to 87 trillion here in the U.S. In China, it'll go from 2 to 8 trillion. So on the one hand, you could say higher growth rate in China, but there's like 10 times the wealth here in this country versus China. So does that make the argument, if we're connecting the dots here, for just keeping the money here and investing in U.S. stocks?
Well, I mean, Adam, I would kind of split the difference and say that we're still a very wealthy market. We're going to continue to grow. And I put Europe in the same boat. It's on the margin. It's the rate of change, velocity of change in China that will help drive automobile sales, telecom, computers, hopefully financial services for like a bank like Bank of America. So it's the velocity of change in these emerging markets that can have I think, more of an immediate impact. But you're right in the sense that wealth is still concentrated in the West, but it's shifting to the rest unequivocally.
Joe Quinlan.
It's broadening out.
Got it. Joe, thank you so much. Joseph Quinlan, he's the chief market strategist over at U.S. Trust Bank of America Private Wealth Management.